Hello there, and welcome to this week's episode of Mondays with Matthew. A couple of months ago, I recorded a video to share my thoughts on conventional mortgage rates at a time when COVID-19 had started hitting the US economy and we were seeing some massive swings in both mortgage and treasury rates over a remarkably short period of time. Well, since then, things have settled down a little, so I thought it would be a good time to revisit the topic and give you, hopefully, a little clearer view as to where I see mortgage rates moving for the rest of this year, and also give you my long-term forecast for 2021. So, what's been happening since we last took a look at rates? Well, they really haven't moved that much. When I last spoke to you, they were averaging about 3.3%, and now they're at 3.15%. Hardly exciting. But it did tell me that the Federal Reserve was successful when it decided to step in to support the US economy as COVID-19 was ramping up. And we can tell their success because of the relative stability in rates. But there's a bigger question now, and that is how much further down the rabbit hole of supporting the economy and housing are the Fed prepared to go? So I was thinking about this. I took a look at the Fed's balance sheet and the figures are truly staggering. Today, the Fed holds about $4 trillion in bonds and about $1.8 trillion in mortgage-backed securities. See, their post-COVID-19 shopping spree has been very aggressive. They've purchased about $460 billion of mortgage-backed securities since the middle of March, clearly in support of both the economy and the mortgage markets. But I looked at the last 10-year Treasury auction that happened a couple of weeks ago. And although the Fed, well, they were certainly buyers, they jumped in for about $35 billion worth of purchases. Well, that was down from $40 billion they spent on 10-year paper at the prior auction. So this begs the question as to whether this is a sign that they'll continue to limit their purchases of treasuries. And if they do that, what does that mean for mortgage rates? Well, obviously, as many of you will know, mortgage rates are heavily influenced by the interest rate on government securities, with 30-year interest rates, mortgage rates that is, tracking 10-year treasuries remarkably closely. Or it did, but I'll get back to that part a little bit later on. Well, you know that I do like to offer a little perspective when I share my thoughts with you, so let's take a quick look back in history and how mortgage rates have moved over time. This chart shows the conforming 30-year fixed-rate mortgage going all the way back to its inception in the mid-1970s. Well, first off, I do need to give a hat tip to my colleague Leonard Kiefer over at Freddie Mac, and it was Leonard who first came up with looking at rates this way, and I think it tells a really great story. So you can clearly see the trajectory of rates over time, with a peak at just below 20% back in the 1980s, followed by a downward trend all the way to the 2020 average of 3.5%. A truly remarkable drop in borrowing costs. So what can we expect for mortgage rates as we move forward? Well, the Fed is very influential when it comes to interest rates on mortgages, as they influence them by buying or not buying treasuries. But I just don't see them pulling back their purchases of debt anytime soon. Chairman Powell has been very direct in stating the Fed's unwavering support of the economy. But it's not just because of that. I also see the Fed continuing to buy debt because of the US Treasury. See, last month, the Treasury announced that it would need to borrow another $3 trillion before the end of June. Now, this is a truly massive figure. And to give you some kind of context, it's actually, 6 times the size of its borrowing in the first quarter of this year. And it's almost triple the total borrowing for the whole of fiscal 2019. And to fund this borrowing, the agency said it would boost the size of its auctions of 3-year, 10-year and 30-year bonds to record amounts. Now, because of this, I just don't see the Fed pulling back too much because of their fear that if they aren't an active buyer, rates might rise and that could certainly hurt any form of economic recovery. So if the Fed remains as buyers, what will happen to mortgage rates? Well, I mentioned earlier how important bonds, especially 10-year Treasuries, are to calculating mortgage rates. As you can see here, interest rates for 30-year fixed-rate mortgages and 10-year Treasuries, well, they track each other almost perfectly, or they did, up until March, when the relationship went completely off the rails because of the coronavirus. When the virus appeared, the Federal Reserve moved swiftly to support the economy by firing up the printing presses. That's right, quantitative easing all over again, and using this money to buy a lot of debt in the form of bonds. And this obviously led the interest rate on those bonds to drop. But mortgage rates didn't really react that much, or at least they haven't so far. Now, the average interest rate on a new 30-year fixed mortgage in May has fallen to 3.15%. That is the lowest rate on record. That's a record going back almost half a century, but it's actually not significantly lower than the old record. Now, at the same time, US 10-year Treasury yields, well, they sit today at just under 0.7%. Now, that is also an all-time low, but it's almost a full percentage point lower than the old record, and that is huge. The spread between mortgages and the benchmark rate averages 1.7, but today it's at 2.5%. Why? Well, because bond yields plummeted. It's only ever been wider. Well, that was one time. That was during the financial crisis back in 2008. And therefore, it's not unreasonable to suggest that even if bond yields remain static, mortgage rates could actually be a lot lower than they are. So why aren't they? Well, one reason is a simple imbalance between supply and demand. As interest rates started falling in March, well, there was a flood of refinance activity, and lenders struggled to work through this pipeline. In essence, there was so much demand that originators were able to keep rates a little higher than they should have been. But the pipeline is being worked through, and refinance applications have slowed fairly significantly. So I believe we're likely to see originators become more competitive. And what does this mean for rates? Well, if you've been hearing whispers of 30-year fixed rates in the high 2% range, well, maybe you shouldn't shake your head and scoff at the prospect, because this could really be the new reality for rates. If we consider the outlook for economic growth and inflation, these are two key considerations when thinking about interest rates. Well, it's not too much of a stretch to believe that we could and should be at rates significantly lower than the levels we see today. As I was putting my thoughts together for this video, I took a look at some other economists' forecasts to see where they are holding rates. And here are their expectations, along with mine, for the second half of this year. As you can see, both the National Association of Realtors and Wells Fargo Bank are both predicting rates breaking south of 3% this year. Now, these forecasts clearly suggest the Fed will continue to buy bonds as needed and that rates are set to drop further. I'm afraid I just can't get my head around sub 3% mortgages quite yet, but others certainly they see it as a real possibility, and their math actually holds water. You see, if you look at where 10-year Treasury rates are today, and knowing that the average spread between 10-year paper and 30-year mortgages is 1.7%, well, add those two numbers together, what do you get? Well, it implies a mortgage rate of around 2.6%. Now, this final slide gives you my longer range forecast for rates, and I'm very comfortable in saying that we will remain in the very low 3% range until 2022 at the earliest. So there you have it. I still expect to see rates remain remarkably low for quite some time, and this obviously bodes well for the US housing market as we move through the current economic downturn and hopefully into a more vibrant economy in 2021. As always, if you have any thoughts about this subject, or if you've got a question you'd like me to talk about, I would love to hear from you. Take care out there, and I look forward to visiting with you all again next week.